Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Well, it must be Friday, because here we are.
Bob, we like to start off our show answering listener questions, and we have several once again this week. First of all, we have this comment and question from Michael. Michael says, "Hi, Jim. HowStreet.com is the place to be for insightful financial analysis. Thank you. My two questions for Bob. The financial waters are choppy enough with the usual sharks and vampire squids that manipulate price, but now the whales seem to be having a growing impact on price discovery. Not long ago, there was the London whale who created a huge wave in the CDS market, resulting in a $6.2 billion loss for JP Morgan. Then there was SoftBank's NASDAQ whale, who recently manipulated markets with a tsunami of call options. Also notable, the 1,000 Bitcoin whales who control 40% of the market. Bob, can we little fish survive in these financial waters so overpopulated by these killer whales?"
Oh, boy, that's a good one, Michael. Yeah, well, what's the old saying? There's bulls and bears in the market, but there's no room for pigs. And that they're now calling them whales and squids and stuff is really quite incredible. But, you know, the size of the account doesn't necessarily imply the right behavior at the top of a market. I know that back in the late 60s, the bull market was the assurity was that fund managers were switching over from traditionally heavy weighting in fixed income to equities. And this was the forever bid. And not only that, but professional fund managers would sort of take some of the choppiness out of the market. So that then into 1968, 69 bull market, which was new issues, by the way, market. I remember that one. You had take a high on the Dow and deflated by the CPI inflation, and the subsequent bear market was more than 60%, all the way down to the first part of 1982. So the concept of very large players being in the market is not new, nor is the concept that they can get it right. And as Michael listed, there was one there where it cost $6 billion for Morgan. So the numbers just get bigger. But the market is always fascinating. And then there was a second part.
Michael asks, "Bob, can you please explain the difference between a liquidity event and an insolvency event? It is said the Fed is backstopping liquidity shortfalls, but with all the debt piling up, could we see an insolvency event like we did back in 2008?
Yeah, Michael, you're on with that one. This is one of the naive parts of intervention of central bank thinking, is that they think if they suddenly provide some liquidity, it'll solve the problem. But the problem is when the balance sheet's so offside that you're insolvent, and it doesn't matter what the level interest rates are or what the availability of immediate liquidity is. If you're insolvent, you're insolvent, and this is what is always discovered after a speculative mania. Now, what we've been looking for is the rebound that's on the way recently. And then the next question you ask is, when's the next natural high? Well, you've had some terrific speculative markets complete in the December-January window. We call it the turn of the year. And I guess one that was great was the Tokyo Nikkei speculation, which had a terrific bubble when the rest of the world wasn't really bubbling, and it ended on the last trading day of 1989. So, and then a while ago I found a market that completed in that window in 1893 it was, and we're writing that one up, so we'll eventually publish it. But Michael, thanks for the two questions.
Another listener question, they comment, not so much a question, but a lament. Why do gold miners start wasting money as soon as they make some? And they highlight the headline, gold miner Newmont to spend $500 million over 5 years on climate initiatives.
Oh, dear. It's so sad. But corporate boards and management are getting on side on all of this climate stuff. And it's really an absurdity, but it's not the first time big gold miners have done stupid things. And I go back to Gold Corp when on a long bull market for gold and the gold stocks, they were brilliant in all kinds of hedging operations they were running. And then I know definitely of a prominent gold mining broker in Toronto, and he also introduced me and our research to Gold Corp, and we pointed out to them that this has been a wonderful strategy, but the price of gold is about to head south. Oh, no. And then, so the $1 billion they made on the way up, they lost as much on the way down. And then, when it became very painful and very obvious, then they unwound all that hedging operation they were doing. So now, to see Newmont spending $500 million on climate initiatives, very sad and a good reason to avoid owning the stock.
Our third question, or I guess number 4, is from Juma in Long Island City, New York. Juma writes, Jim, I hope you're well. I hope you're well too, Bob. I'm a big fan of your show and interviews. I live in Long Island City, New York. And the question for Bob is, in the past, I believe Bob has said that based on history, he expects inflation in a financial bubble contraction. However, in the past, the dollar was fixed to gold. Since that's not the case now, would the deflationary environment Bob is expecting be in terms of gold, but not dollars? Thank you.
Yeah, well, gosh, you get all kinds of nuances in here, Juma. But we can just quickly go to the 1873 bubble, and as it occurred in New York, it was a global bubble, Europe and London and everywhere, a great bubble like 1929. And in London, the chief editor for The Economist was Walter Bagehot, and he wrote a book that year called Lombard Street, which was about the financial markets in London, and he addressed the problem of recessions and contractions, and he said, no, there's nothing to it. All you have, the Bank of England has to act appropriately by providing liquidity. And then in the New York market, you had the Herald newspaper, and of course during that summer, the bubble was obvious, and strains were coming into the credit markets as usual. And so the newspaper editorialized that nothing could go wrong. And the reason is because the U.S. did not have a central bank, and in not having a central bank tied to gold, that left the Treasury with lots of room to flood the money markets, which it did. And it didn't work, either in London or New York. And at that time, London was the center of the world's economy, and it suffered a serious contraction. It was sort of ongoing, and in 1884, the senior economist in England pointed out that it was they actually called it a, quote, Great Depression. And it ran from 1873 to 1895. And in in the U.S., you had this huge migration in. You had huge migration from rural into urban, and tremendous economic innovation. So it had the ups and downs that London had in the financial markets, but not necessarily the severity of the contraction. So that was a classic example of the United States being on a fiat currency system, and it didn't work. So I have seen no reason why it won't work here. They get huge juice into the market when the market wants to go up, and then you also get very severe cracks when the market wants to go down. And through the fall, it was obviously that the street was going to take any news item, good or bad, it was going to be bullish. But you did have a correction down into October, and then when it started up, we then turned around and said, hey, how far can this go? And the turn of the year is a natural, and as I said a little while ago, the signs of speculation are there. Now, if there were no signs of speculative excess, the uptrend would continue. But in that we're getting speculative excess going into the time window when terrific speculations can end. Another one was the madness in gold and silver in that went through the 70s on the big inflation story, and they peaked on January 21st, 1980, and then went into a lengthy bear market. So we're watching for a peak, and our special technical tools will help give us the trade.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, a headline that caught your attention: global investors pour money into Asia's red-hot markets. What's going on in Asia?
Oh, more of the madness, isn't it? It's doing huge new issues. It really is. Well, they call them in the U.S. IPOs, initial public offerings, but my gosh, historically they've always been called new issues. And in the 1720 South Sea bubble in London, there apparently were more than 400 stocks floated. One, I think it was a fairly realistic account at the time, pointed out that the stock story was so good that nobody could know what it was. It couldn't give away the secret, but you had to put your money into the deal. Now, there's a whole range of those coming out lately. I forget what they call them, but they are sort of like shell companies raising all kinds of money for good deals yet to go in. So, and then eventually the mania burned itself out. And my own experience was I was on the institutional equity desk here in Vancouver with a very good regional broker, and we were underwriting new issues like mad, and they were coming out and doubling or tripling in an instant, so to speak. And so you made a score on one, and then you wanted to have more of the next new issue that the company I was with was doing. And so, of course, a lot of the retail accounts got onto that as well, and they were getting cut back. And the more popular an issue is, the less of it you're going to get. And so they would then give their retail broker in the firm an order for 3 times what they wanted or something like that. And then a couple of guys that we watched their path would go to a trust company, open an account and put in an order there, or open an account at another broker and put the order in. So, and one of these guys was pretty nasty. I still remember his name. And while it was on, it was really fun and a sure thing. And then came the issue that broke the back of the whole play, and I think it was called electronic data processing, EDP. And all of a sudden you realized it was that the issue wasn't going to go. Something had changed. And these people who had put in double or triple what they wanted, they got filled. Absolutely. And, of course, they then tried to renege. And then the partners in the brokerage firm, no way, they wanted it on the books. So maybe the guy gave up a year and a half's bull market of profits just by getting greedy on the one last trade. Now, right now, which of these hot new issues will be the last one? You can't tell until it happens, but it'll be sure fun to watch.
We'll have more with Bob Hoye right after this.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, as the Asian stock markets are booming, headline says China close to first consumer price deflation since the last crash in 2009. What's the story there?
That's what the headline was, and obviously the Main Street side of the boom in China could be cooling, and then you've got. I didn't grab the headline, but there was one last week on a Manhattan condo apartment that 4 years ago somebody bought for, let's say, $35 million, and it sold for, I think, $20 million. And that's not inflation at all. So if the big boys are losing that kind of money, and also it reminds me of in the 1920s boom when Florida real estate became the mania, and I think it peaked in 1927 and was backing off well before the bubble ended in 1929. And then, of course, into the 1930s, property from major buildings such as the Empire State Building all went into serious decline. And actually, Jim Grant, the interest rate guy who writes such wonderful books on the financial markets, he did a study on the Excelsior Life building built in Manhattan, and then noted that during the contraction after 1929, not only did the equity holders of the building go broke, but also those who provided the mortgages went broke. And then also Kennedy, the senior Kennedy, that made all the money for the Kennedy family, he bought the big trade building in Chicago. Can't think of it at the moment, but he might have bought it in the 1940s, and it was largely empty, just sitting there as an immense white elephant. And it wasn't until about late 50s that began to generate some income. And then that was also the same with Jim Grant's study of the Excelsior Life building. It took a long time before it became profitable. So we're staying with the theme that you have a decade of speculation in tangible assets with inflation, and that goes into a boom, and then it crashes. Then that sets up a decade of inflation in financial assets, such as stocks and bonds, and that goes to a climax. Does it look hot out there? Yeah. And then it crashes, and then you go into deflation. And this is the sixth time that this has happened since the South Sea bubble of 1720, which was preceded by a huge commodity boom that ended in 1711. So when you see the pattern happening 5 times before and leading to a deflationary contraction, and you see that we are now in the midst of another classic financial bubble, you got to stay with the same conclusion that you're going to be hit with deflation in most prices, except for the real price of gold. But keep in mind that the Fed in 1929, the New York Fed, eased. It bought bonds out of the market, injecting cash liquidity, and the New York Fed exceeded its lending authority by a factor of 6 times. It was huge ease they put in. And then you had Barron's in July 1932, which was the end of the first bear market, so it was a bad time to be writing. But they pointed out, essentially their editorial was, every anti-deflationary measure taken by the Federal Reserve System is seen not to work. And also that editorial pointed out that the anti-deflationary measure was buying bonds out of the market. So the theory that some agency now is going to be able to provide liquidity and make things go has been tried in the past, and it hasn't worked.
It was a mega week for IPOs on the stock market. What's the story behind that, Bob?
Again, it's the new issue market. Absolutely crazy. And, of course, the size of these things are mind-boggling, but a new issue is a new issue, an IPO is an IPO, and a craze to buy a new issue market is symptomatic of the top of a bubble. So, and I wrote the other day that while one can't put actual numbers to it, but I've been in the market consistently all the way through the period, and I think there's been nothing like it since 1968 and 1969 for new issues, new brokers coming into the business, and many new accounts coming into the business, particularly with the Robinhood trading facility, where a bunch of people were suddenly at home and checks started coming from the government, so that was fine to go speculating. You had a new issue come out the other day. I think it was up 2,900% on the first half of the day, and then it backed off. the securities people did the right thing and halted trading a few times. But I know decades ago on the Vancouver Stock Exchange, on a hot market, if something moved 20%, it was halted trading until the company came out with a news release. So I think the Vancouver Stock Exchange authorities used to be better at policing wild action than New York is now. So, but I love it. This is history being made as we watch it, and it'll be fascinating to watch it. Somewhere over the next, say, 6 or 7 weeks would be the time window when this buying frenzy could max out, and we just have to watch it and see how it goes.
Happy Hanukkah, Bob.
For sure, and many to you. Yep, it's that time. We hope that the Santa Claus rally comes in.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. As you heard, Bob loves to answer your questions. You can send them to info@howstreet.com. And if you'd like to include your name and your home city, that's very nice too. Find us on Twitter @HowStreet. We're also on Facebook. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.